One is, how do you think about why, if you could be so great at asset management, why do this other thing as well? And the other is, what has been the secret to success? I know it's technology, but if you can go into a little bit more, that would be great.
So, first of all, I think it's important to be clear that our asset management business is driven mostly by our performance fees, which are our profit sharing with our investors. So when our investors make money, we make money, and when our investors don't make money, we get paid very little. And this alignment with our clients puts us in a position to be laser-like focused on both identifying opportunities and managing the risks of the portfolio. So unlike most of your traditional asset managers, we're in a very different business in terms of having to be just continually focused on how do you have in the marketplace a competitive advantage in identifying mispriced assets and opportunities around the world. So that brings us back to the core of our market making business, which is around predictive analytics. In the hedge fund, we spend an incredible amount of time forecasting where we think, for example, the price of natural gas will be in the United States, where the 10-year bond yield will be a month forward. Think about that mindset of forecasting future prices and bring it into a very short-term horizon, say the next, and then apply those forecasts in thinking about how you manage the risk inherent in a portfolio that is given to you in your capacity of providing liquidity to the marketplace. So at 100,000 feet, we're in the forecasting business. And in the hedge fund, our forecasts tend to be forecasts that are measured over weeks or months. And in the market making business, those forecasts are thought of as being measured in the course of minutes, hours, or days. But at the core of both of these businesses is very much a focus on predicting what the future will be. So, for example, in the market making business, you'll see technologies like machine learning being used to build your forecasts of future stock returns.
Got it. Good. So let's dive right into GameStop. So kind of, if I'm going to start just by because GameStop was a little while ago, so I'm going to just do a quick. There's a little blurb here on Wikipedia, and I just start by saying I don't represent. By no means do I represent what's on Wikipedia as the truth, but rather just sort of as an expression of kind of the gestalt of the commentary. Especially around that time, and just to kind of refresh people who have kind of fuzzed out on the details. So. January 25th, it was announced that Griffin Citadel would invest $2 billion into Melvin Capital, which was the hedge fund that had suffered losses more than 30% on its short positions, particularly on GameStop. On January 28th, Robinhood, an electronic trading platform favored by many traders involved in buying GameStop stocks and options, which, by the way, my firm's involved in, abruptly announced that it would halt all purchases of GameStop securities except to cover shorts, and would only allow those securities to be sold if already held but not sold short. So in other words, Robinhood cut off basically the ability for the retail traders who were torturing GameStop and Melvin Capital at the time from being able to trade. The price of GameStop stock declined steeply shortly thereafter because Robinhood receives a substantial portion of its revenue through a payment for order flow relationship with Citadel Securities LLC. Many commentators criticize the potential for a conflict of interest where the same entity plays the role of market maker and also participates in the market that it makes. And of course, in this case, also was a major investor in the hedge fund on the other side of the GameStop situation. So I wanted to start, and obviously, please critique any of that's false. But just more generally, I would love to hear, and I know everybody would, kind of from your perspective, basically, like what happened? Like, what is the true story of what happened during that period?
So, in broad strokes, Melvin Capital was short a variety of stocks that became of interest to rather savvy and sophisticated retail investors who realized that the amount of stock short was just disproportionately large relative to average daily trading.
Mm-hmm.
And these retail investors, realizing that there were these unduly sized short positions in the marketplace, started to buy these stocks that caused the hedge funds that were short these stocks to start to incur losses. And when firms are losing money, they almost reflexively start to cut their own risk.
Mm-hmm.
So in this case, they start to cover their shorts, and you end up in this reflexive pattern that as retail's buying the stock, pushing it higher, the hedge funds that are short are covering their shorts, pushing the same stock price higher, and this virtuous circle becomes incredibly painful for the hedge fund managers that are short the securities of interest. And we saw this virtuous circle playing out in the marketplace. And on the day that we invested in Melvin, we thought that this had run its course.
Mm-hmm.
In fact, it was very clear in the morning of the day that we made the investment that this short squeeze was apparently dying down.
Mm-hmm.
And we invested money into Melvin to take advantage of the fact that a number of their shorts had become very inflated in price, and we expected those prices to revert in due course, and we'd have made a successful investment.
Right.
And at that moment, the world changed. We had the social media landscape with some very important influencers really lit up on the story of GameStop as being a stock to get long and to ride to the moon.
Yep.
And Melvin continued to cover their short very aggressively over probably the next 48 hours, give or take. I can't remember the exact timing of this. Now, ironically, I'm almost certain that Melvin had covered their entire short before the 28th.
Mm-hmm.
In fact, they put out a press release, and the press release would give the exact timing of it. I don't recall that off the back of my hand, but I'm pretty certain that by the time that Robinhood stopped trading on the 28th, Melvin had already covered their short and moved on.
Mm-hmm. And basically just taking the losses would be the way to think about that, right?
Yeah, they'd taken their loss and they moved on.
Yeah.
I mean, part of what good risk managers do is when they're wrong and they can't understand what's taking place in the marketplace, they take it on the chin, they take their loss, and they move on.
Mm-hmm.
Now, Robinhood had a distinctly different problem than Melvin had. They had a problem of too much success. Robinhood had opened accounts with millions of retail investors who, seeing this price dynamic playing out in GameStop, seeing some of the really important influencers in financial markets advocating the purchase of GameStop, we saw an absolute deluge of retail buyers of GameStop unlike anything I think the markets have ever seen before.
Mm-hmm.
The problem this created for Robinhood is this very concentrated position of buying required them to post good faith margin with the clearinghouse that everybody on Wall Street uses.
Mm-hmm.
And I believe that good faith collateral requirement was order of magnitude $3 billion.
Yeah, that's right.
Of cash.
Yep.
And Robinhood simply didn't have $3 billion of shareholders' equity to draw on to post that margin.
Mm-hmm.
And so, because of their incredible success, they needed to restrict trading at that very moment in time where I'm certain they would have wanted to continue to trade to gather the revenues associated with trading, but they couldn't because they had to let some of those purchases work their way through the settlement cycle to release the demands for cash collateral.
Mm-hmm.
And of course, as you know, Robinhood was out trying to raise capital at that moment in time to generate more cash to give them the flexibility to make the margin calls that they had to make.
Mm-hmm. Mm-hmm. Yeah, and in fact, you may know our firm participated in that round in that sort of injection.
And I'm certain that was a successful investment for your firm.
Yeah, that was good. There's a couple of kind of claims that have kind of went viral around that time that I think probably are still kind of still circulate around. So yeah, one is this kind of idea So this idea that on the one hand you've got this relationship with Melvin Capital where you're now a big investor, on the other hand you've got this relationship with Robinhood, where they get a lot of their revenue from for payment for order flow through through your market maker, and so there's this perception developed that you're kind of sitting in the middle of this web and kind of pulling strings, and then there's this kind of shadowy consortium or whatever they call it in the background, and they're issuing this overnight demand for money, and that's presumably like somehow rigged up by Wall Street. So like how do you kind of process through like like what was your reaction to kind of finding yourself in the spotlight on that kind of thing, and how do you kind of process through trying to explain to people what the reality of the situation was?
Well, I have to say that processing conspiracy theories is not one of our core competencies.
Mm-hmm.
So we were a bit slow out of the gate to dispute this ridiculous set of claims, just given like we don't find ourselves in the middle of conspiracy theories very often.
Mm-hmm.
So as a large market maker, in fact, the largest market maker in the market in late January, in GameStop, in AMC, in the other meme stocks, we were very interested in seeing the continuation of trading both buys and sells. One-way flow is a really difficult proposition for a market maker.
Mm-hmm.
All you do is you've got one-way flow. So if people keep selling you stock, you keep accumulating inventory. What are you going to do? You
Mm-hmm.
make your money as a market maker from the bid-ask spread of buying and selling, getting into and out of a security over the course of a day.
Mm-hmm.
So we, as a market maker, we're the largest market maker in this period in late January because of our operational capacity to take on the operational risk and capital demands that were inherent in this incredible increase in participation by retail investors.
Mm-hmm.
So in contrast to Robinhood, we had the financial strength to meet our collateral calls. We had the operational bandwidth to meet the demands of the marketplace on our business.
Mm-hmm.
And then with respect to Melvin, as I spoke about it earlier,
Mm-hmm.
their short in GameStop was, to the best of my knowledge, like already gone or virtually gone. It wasn't even in our minds on the day of the 28th. Didn't even think about it. And so the fact that people made that connection ex post was certainly not a connection that I'd made a priori.
Got it. Right. So you weren't sitting there thinking we have to optimize the value of this investment we just made in Melvin Capital.
No.
Okay. And then there's two just absolutely and then I want to let Alex ask more detailed questions, but there's just two things that are just that I actually learned. I knew kind of intellectually, but there's something I knew intellectually, but didn't realize kind of emotionally or viscerally until I saw it happen, which is you can't, if you are short a stock, if you're a fund and you're short a stock, you cannot, and Ken, correct me if this is wrong, you can't close out that short without delivering that stock. Right, which is to say, like, I can't, if I'm short whatever and it's whatever, I offer you $100 to close out the position, $500 to close out the position, $1,000 to close out the position, $10,000 to close out the position. I can't close out the position without the actual share of stock because because basically there's in theory potentially a limited downside if the stock keeps rising. Is that technically true?
So for 99.99% of the situations, of which this was one of that 99.99, you had to buy the actual shares back if you were short and trying to cover your short.
Mm-hmm.
So for all intents and purposes, one should view if somebody's short a stock, they're going to have to one day buy those shares back in the marketplace as a regular way trade.
Mm-hmm. By the way, just out of curiosity, what's the 0.01% exception?
I sometimes professionals over the years, I've seen people willing to settle a short for cash in lieu, but that's almost always the context of things like tender offers for a company.
Okay, right.
So if a company's being bought for for cash, let's call it, General Electric's going to buy a company, they're going to pay $24 a share. Once the tender closes, if you were short that stock, since the tender's closed, the company's been bought, you can, under those circumstances, settle your liability for cash.
Yeah. But what you're describing is a particular kind of bounded situation with presumably minimal risk. In contrast,
the shares are gone, the company's been bought, and how do you wrap up that contractual situation amongst the parties?
Right. But if there's unlimited potential future downside, you can't get a counterparty who will settle you out for anything short of the actual stock.
If one of the challenges that you have as a short seller is your risk is unbounded.
Right.
And so that's why when people are constructing portfolios of longs and shorts, their short positions tend to be much smaller than their long positions on a relative basis, because the risk on the short side's unbounded in comparison to the risk on the long side positions.
And then that leads to the second thing, which I called up the GameStop stock price. I get the terms GameStop stock and stonk confused in my head all the time now. But the GameStop stock price, we're sitting here now, almost a year later, and it's still the market cap of the stock price is still $179 a share, which is up, it's up 1,000% from a year ago. And the market cap of the company is almost $14 billion. And if you look at the chart, it's not quite, it's not at the all-time high that it got during the truly crazy period, but it's not that far off. It kind of peaked out at over 300 and it's still at 179. It certainly hasn't fallen back to where it started. Are you surprised that, and I guess, but I guess the logical implication of that is there are still, the suggestion I think that price might be telling us is there are still funds out there that are short that haven't been able to buy back, and the Reddit horde is still torturing them, or is there some other explanation for, or maybe the company's, by the way, much better, right? Is the other possibility. But are you surprised that stock has held up? Because I think a lot of the commentary at the time was obviously this thing is going back to near zero.
Well, I think it's an incredibly complicated situation. First of all, the management team of the company did a great job of buying back its own stock, ballpark 2 years ago at much, much lower prices. Mm-hmm. So the company bet on its own future and bought back a fair number of shares. I think it was in the single dollars per share back, roughly 2 years ago. And that's in rough strokes. I'm not a GameStop expert per se, but my memory serves me right. That's what they did about 2 years ago. And then there's been the rise of a significant new investor, the founder of Chewy, mm-hmm. and he has an incredible reputation as being an entrepreneur. Yep. And of really understanding how to connect with the consumer in a profound way in an e-commerce environment. And if somebody's going to figure out how to turn GameStop into a successful e-commerce based platform, he'd be behind the list of people to do it.
Yeah.
And that's the question. Can they pivot from a huge footprint of stores around the world with a relatively high cost of distribution to an e-commerce led company with a broader mandate that's able to engage the consumer in a profoundly different way? And the market price today reflects people's views on that very same question. Yeah. The current short position in the stock is actually quite trivial compared to what it was just a year and change ago. Mm-hmm. Virtually all the short players are long since gone from this name. They've given up trying to understand how to price GameStop with the founder of Chewy at the helm.
Yeah, if you look at the 5-year chart, it looks, pardon the metaphor, it literally looks like a corpse that suddenly came back to life. It's just this flat sag for 4 years, and then there's this crazy spike, during the Reddit drama, and then there's this kind of choppy, but fundamentally, as you said, kind of this kind of new normal, at least for the last 9 months.
Yeah, the question here is, and I play my Xbox. Yep. I just got Call of Duty Vantage. I downloaded it.
Yep.
I didn't walk into a store.
Yep. Well, I mean, that was the presumption, right? Prior to the Reddit guys figuring out the short situation, right? That was the presumption, right?
That was the presumption. The presumption was the world was going to go to digital downloads so fast that GameStop would not be able to change its cost structure quickly enough to adapt to that brave new world, and they were going to meet the same fate as Blockbuster.
Yep. Right.
Right. And Blockbuster actually dates you and I once again. Videotapes to a lot of people are just like they see them in movies. They don't actually know that we actually went to Blockbuster and used to rent them.
Well, there's actually, Ken, there's a new Netflix movie coming out to pour salt in the wound. I think Netflix is making a movie. I think it may just have come out called the Last Blockbuster. And it's literally a movie about the last video rental store. So at long last, they've I think they're spiking the ball in the end zone. So
that is pretty funny. And so that's the question: will the management team at GameStop find ways to connect the consumer that are different than what they were doing 3 or 4 years ago, that create value for consumers for which they get paid to do?
Yeah, and then
go ahead.
Yeah. Good. Well, the reason I brought this up, the 5-year chart, is it goes to the point you made, which I just want to explore one more level, which is, this is a situation, like, you can tell a very different story here. And the story basically is they had this, they were in trouble. Then they had this exogenous event caused by, the mechanics of the stock market. And then, to your point, like, they have seized, in the best case scenario, they've seized on the exogenous event to now construct a better future for themselves.
No doubt. And
right.
they raised a tremendous amount of capital,
right,
to create a war chest that gives them the flexibility to pursue a variety of different business strategies.
Yeah, and so it's like this unusual reverse move, though, where it's and by the way, we see this in our business, and it's speculation creating reality, right? Like, potentially in a really positive way.
So the markets will judge that in retrospect.
Right.
Were the people that bought GameStop stock from the company over the course of the last year brilliant or not? And we'll find out based upon the success, the failures or success, the merits of where GameStop takes their business.
Yep. Good. Okay.
And by the way, that's what makes America's capital markets work. Differences of opinion drive our capital markets. Just remember, a few months ago, Hertz was left for dead in the middle of the pandemic.
Yep.
They were in bankruptcy.
Mm-hmm.
And they went to raise money in the stock market, and the SEC said, you can't do it, an offering, you're bankrupt.
Yep.
Right? And now Hertz is this incredible success story.
Yep.
So I think we have to all have some level of humility about our ability to forecast how any given company is going to progress, prosper, or fail.
Well, I think that's one of the great things here is that it turns out retail is very smart. Sometimes called retail dumb money, but actually, smart on Tesla, smart paradoxically on something like Hertz, which was bankrupt, and potentially smart on many of these others. One of my favorite things is if you Google Apple IPO Massachusetts, there's an article in the Wall Street Journal about how the state of Massachusetts, to protect the general public, banned their participation in the Apple IPO, which is, of course, now the biggest company in the entire world. So it turns out sometimes retail investors are smart, and I would argue that right now it's a better time to be a retail investor than ever before.
I think it's always important to remember that a number of your retail investors they're intrinsically optimists, and when they see a great product run and a company run by an inspired CEO, they're willing to put their money on that. They're willing to believe in the future of America. They're willing to believe in the Tesla story.
Yep, and get rewarded appropriately, and motivate more entrepreneurs to build more companies like that.
Mm-hmm.
Yep. Good. Okay. Look, I would love to keep going. We have, we could go for hours on this, but we're coming close, Ken, to the end of your time. So I wanted to I wanted to ask you about the other thing you've been in the headlines for recently in our world, as well as more generally, which is your purchase of the U.S. Constitution and your competition, and your just very narrow, I think, trouncing, but your trouncing of the Constitution DAO Web3 project that got a lot of attention. A consortium of Web3 crypto people that were trying to buy the same Constitution. So maybe tell us a little bit about that. How did that go down from your perspective?
So first of all, it didn't go down. The Constitution is one of the most sacred documents in the history of our country. And as many of you are aware, I have a great passion in governance, in public policy, in how to make sure that America stays the land of opportunity. It's incredibly important to me. It's a huge focus of my charitable activities is to broaden the safety net in America, to create opportunities for people to go to our finest schools, to ensure that America continues to be really that shining light on top of the hill. And so when that Constitution came up for sale, I actually saw it several weeks before the auction. And it's one of those moments I walked out of Sotheby's and told a friend, I'm like, I'm going to buy that. No. Because to own such an important part of the history of America, and really the profound wisdom of the words transcribed on that paper by the thought leaders of our nation, that was truly important to me. And then nothing like seeing the Constitution Dow raise just a mind-blowing amount of money in a few days in front of the auction.
Mm-hmm.
And what a statement about community.
Mm-hmm.
I mean, I am blown away by the passion of the community to come together to share this document with our country. And just as I will share this document with our country, I was really impressed to see so many Americans willing to put up money to make that happen as a reality. And so the night of the auction, you know, what I've learned over the years in auctions, simply the person willing to pay the most wins.
Yep.
There's no grandeur in being the winner at the auction. You're just willing to pay more. In fact, you might be saying you're the person willing to pay more than anybody else in the world at that moment in time. That's not always where you want to be in life.
Yep.
But I was fortunate enough to have the financial resources to acquire the Constitution. And as you're well aware, I've already committed to lending it to Crystal Bridges, where it will be shared with, hopefully over the next few years, millions of Americans. And Crystal Bridges is a really special place. It touches the Midwest in a profound way. It touches the South in a profound way. A huge number of the people that go to Crystal Bridges have never set foot into an art or history museum before in their lives. And to really share the American vision with so many people, I hope is an inspiration to our youth about the greatness of our country, about the greatness of our founding fathers. And we didn't get everything right, but we changed the world, and will inspire people to pursue both public service and to pursue how can they make America better.
Yep. When do you think? Where exactly is that, and when do you think people will be able to go see that?
So it's going to Crystal Bridges. I don't have their opening date yet, but it will be early in 2022.
Got it. That's fantastic. That's great. Hopefully a lot of people go. I would love to. I would love to go see that. Good. So I can't think of a better way to end the conversation, and we're right at 6. So Ken, want to thank you for your time and for getting into these exciting topics with us, and we really enjoyed having you.
What a pleasure. Great to be with both of you tonight. Thank you so much for having made the time.
Good. Awesome. Fantastic. And thank you everybody in the audience for joining us, and we will be back. We'll be back soon.
Okay. Thanks so much. Thanks, Ken.
Great.
Thanks, Ken.
Great. Good night, everybody.
Thanks, Ken. Thanks, everyone.